Hello learners, I welcome you once again to our today's lesson. We will be introducing a new topic, which is the cost of capital. So I'll start by giving a brief adumberation of the topic. Now in this topic, we'll be looking at the introduction to cost of capital. We'll also study the concept and significance of cost of capital, factors influencing cost of capital, components of cost of capital, the weighted average cost of capital, the marginal cost of capital, the capital structure and financial risk, the factors influencing capital structure decisions. So these are the subtopics that we'll be covering under the cost of capital. So the new topic is the cost of capital. Cost of capital. Cost of capital may also be referred to as the cost of finance, the cost of finance, or the cost of funds. At some point we mentioned when we are studying the topic on the sources of finance, we say that finance is very critical in the operations of an organization. An organization will require funds to meet its obligations, the day-to-day obligations, and a firm will also need money or finance to invest in long-term projects, So we will be looking at the cost of capital. Cost of capital. So what do we mean by cost of capital? Now the cost of capital, as I've said, is also known as the cost of finance. It is the price the company pays to obtain and finance its operations. It can also be defined as the return the company pays to the parties which provide the finance to finance the company's operations. The cost of obtaining finance are known as the implicit or the flotation costs. They are known as the implicit or the flotation costs. So the cost of finance, for you to obtain finance or capital, you may also incur certain costs, which we are calling the implicit or flotation costs. The implicit or flotation costs. The cost of capital is that amount which is paid to the providers of capital. It is that amount which is paid to the providers of capital. Providers of capital. So the providers of capital, those who provide capital to the firm, can be looked at from two perspectives. Providers of capital can be looked at from two perspectives. That is from the perspective of the owners and outsiders. So capital can be provided by the owners of a company, and these are the shareholders, the owners of the company. Capital again can also be provided by outsiders. These are parties who are not necessarily the owners of the company. Now the capital that is provided by the owners is referred to as equity. And the funds or finance that is brought into the company from outsiders from parties who are not owners of the company will be referred to as debt. So the capital of a company can either be in form of equity or in form of debt. And debt may comprise loans, debentures, bonds, and so on and so forth. Equity will comprise the ordinary share capital, the retained earnings, the reserves, and so on. So the providers of capital, I'm repeating, can be looked at from two perspectives, from the perspective of the owners or perspective of the outsiders. That is very important. So capital, in other words, capital will comprise debt plus equity. So total capital will be equal to debt and equity. Debt and equity. So the shareholders or the owners, when owners and outsiders of the company provide funds to the firm, then they ought to be compensated. They ought to be paid. They expect return as a result of the provision of this capital. When they bring money in the company, then they expect a return. They expect a return. So as far as they are concerned, they receive money, but as far as the company is concerned, then it is a cost. I mean, from the perspective of the company, the money that is paid to the owners or outsiders is cost. But the money that the same money that the debt holders and equity holders receive is a return. So that's why we have defined cost of capital as the amount which is paid to the providers of capital. It either appears as a charge against the business to arrive at the profits, for example, interest on debentures, or it appears as a form of distribution of profits, for example, the dividends on preference shares or ordinary shares. So the interest and dividends both represent the cost of obtaining or using the capital. So the cost of using the capital provided by shareholders or equity is referred to as dividends. Dividends. This cost is referred to as dividend. And the cost is referred to as dividend. And the money that is paid to outsiders is referred to as interest. So interest is a cost, dividends is still a cost. So at the end of the period, this interest is deducted from the profits. All right. This is a charge. It is charged against the profits. It's an expense. It's treated as normal expense. But dividends, on the other hand, is treated as a distribution. After arriving at the profit, then the profit, the dividends will form part of the appropriation amounts. So that is very important. This is a charge against the income. This one is treated as distribution. Okay, distribution of profit. So that is the cost of capital. The cost of capital. So the concept of the cost of capital is significant in designing the firm's capital structure. The firm's capital structure. A firm should aim at minimizing the cost of capital and maximizing the market value of the firm. So the cost of capital is a rate of return. All right? It is a rate of return. That means that the funds used to produce to justify their use within the firm in the light of wealth maximization objective. So an investment should be made only if the rate of return on this investment exceeds the cost of capital. So that is what we mean by cost of capital. This is the money that a company incurs or pays as a result of using capital that is brought within the business, either from the owners or from the outsiders. The owners' funds is referred to as equity, and the money from outsiders is referred to as debt, and the return on equity is known as dividends, and the return on debt is referred to as interest. So that is what we only need to understand there. Then we can look at or consider the importance or the significance of cost of capital. But before we do that, I need to mention that the implicit costs or the costs that are paid in order to obtain the cost of capital is known as the flotation cost, as I had mentioned earlier. And for obtaining the cost, this implicit cost for obtaining the equity will include the underwriting commission, brokerage costs, cost of printing a prospectus, the commission costs, legal fees, audit costs, cost of printing, that is cost of printing shareholder certificates, advertising costs, and so on and so forth. The implicit cost for debt would include the legal fees, the valuation costs for security, audit fees, bankers' commission, and so on and so forth. So those are the implicit costs. So what is the importance of cost of capital? This cost of capital, why is it important? Why is the cost of capital important? And I can say it is important because it has application in very many areas, which include, number one, the long-term investment decisions. Long-term investment decisions. Cost of capital can be applied in making long-term investment decisions. In capital budgeting decisions, using the net present value method, the cost of capital is used to discount the cash flows. And under the IRR method, the cost of capital is compared with IRR to determine whether to accept or reject a project. Whether to accept or reject a project. So one application of cost of capital is when making long-term decisions. Long-term decisions. This is the capital budgeting decisions, because in capital budgeting there are methods, various techniques or methods that are used in order to make decisions, one of them being the net present value method. Net present value method. When you are using the net present value method to choose or to select projects, you will use the cost of capital in discounting the cash flows. Discounting the cash flows. Discounting is the process of determining the present value of future amount. So the rate to use is the cost of capital. So that is one application of the cost of capital. Number two, capital structure decisions. Capital structure decisions. The composition or the mix of various components of capital is determined by the cost of each capital component. By the cost of each capital component. We are talking about the composition mix. Composition mix. Composition mix. Composition or mix. Remember, I just said capital will either be in form of equity or debt. So the capital structure is simply the capital elements that appear on the credit side of the balance sheet. Capital structure is simply the elements in the capital section of the balance sheet. And there we'll find either equity or debt. So the amount of equity to have in the capital structure or the amount of debt to include in the capital structure will be dependent upon the cost of these elements or components. So that if the cost of obtaining equity is higher, say 30%, and the cost of obtaining debt is 10%, then it would be advisable to have more debt within the firm than equity. If it is cheaper to obtain capital through debt, then the finance manager would advise to have more debt within the capital structure than equity, and vice versa. So the cost of capital will be very critical, important, or will be significant when determining the composition or the mix in the capital structure. By mix, we are referring to as the ratio between the equity and debt. So that is where one aspect where the cost of capital is important. We can also talk of dividend policy decisions. For example, if the cost of retained earnings is low compared to the cost of new ordinary share capital, the firm will retain more and pay less dividends. Additionally, the use of retained earnings as an internal source of finance is preferred because it does not involve flotation costs. Again, it does not dilute ownership and control of the firm since no new shares are issued. So cost of capital again will come into play when determining or developing what we call the dividend policy of the company. So that if the cost of obtaining retained earnings, remember, retained earnings is a form of equity because these retained earnings belongs to the shareholders. Okay, this is money that is retained for the sake of shareholders. So if it is cheaper to obtain this equity, which is in form of retained earnings, then the finance manager may advise the company not to propose any dividends to the shareholders, because ideally this money is meant for distribution as dividends. So the policy will change such that instead of paying dividends, then within that year the company can have retained earnings as a source of capital, so that these retained earnings can be a source of capital within that period, and that will affect the decision policy. So cost of capital, again, you can see may affect decision policies, the decision policies within the firm, So we are saying if the cost of retained earnings is low compared to the cost of say ordinary share capital, then the firm will retain more and pay less dividends. Again, we have also mentioned that the use of retained earnings as an internal source of finance is preferred because it does not involve flotation costs. It also does not dilute ownership and control of the firm because no new shares are issued. Then another point is in relation to the evaluation of performance of management. Evaluation of performance of management. A high cost of capital is an indicator of high risk attached to the firm, and this is usually attributed to poor performance of the firm. So if the cost of capital is very high for an organization, that could be an indicator that the performance of the management is not good, is not good, or is poor. So a high cost of capital is an indicator. It's an indicator. It's a symptom that management decisions are not good enough. So those are some of the areas in which the cost of finance may be relevant or important. Another aspect we need to discuss is the factors that influence the cost of finance. Factors that influence cost of finance. Number one, economic conditions prevailing. If a company is operating under inflationary conditions, such a company will pay high costs insofar as inflationary effect of finance will be passed on to the company. So economic conditions will affect the cost of finance. Number two, risk exposure to venture. If a company is operating under high risk conditions, such a company will pay high costs to induce lenders to avail finance to it because the element of risk will be added on the cost of finance, which may compound it. Number three, the size of the business. A small company will find it difficult to raise finance and as such will pay heavily in form of cost of finance to obtain debt from lenders. So the size of the business can also affect the cost. Number four, availability. Cost of finance prices will also be influenced by the forces of demand and supply, such as low demand and low supply, which will lead to high cost of finance. Number five, of course, is what we refer to as the effects of inflation. Debt finance is cheaper by the equal amount to tax on interest, and this means that debt finance will entail a saving in cost of finance equivalent to tax on interest. So debt finance is cheaper by the amount equal to tax on interest, and this means that debt finance will entail a saving in cost of finance equivalent to tax on interest. Number six, nature of security. If security given depreciates fast, then this will compound implicit costs or the cost of maintaining that security. Then lastly, the company's growth stage will also influence the cost of finance. Young companies usually pay less dividends, in which case the cost of finance will be relatively cheaper at the earlier stage of the company's development. So these are some of the factors that may influence the cost of finance or the cost of capital. So now with that, we come to the end of our first lesson. We just introduced it. That is the cost of capital. And in this lesson, we have learned that the cost of capital can be looked at from two perspectives. That is from the perspective of the owners, and this will comprise equity, and from the perspective of outsiders, and this will comprise debt. So total capital will simply be equal to equity and debt. So when a company obtains debt, that is loans such as debentures or bank loans or bonds from outsiders, then the company has to pay for the use of such funds. The money that is paid to this outsider as a result of that lending is referred to as interest. So that interest is a cost, and it may be a percentage, it may be denoted into a rate, it may be a rate. On the other hand, the company may obtain capital from the owners, the shareholders, and this can be in form of ordinary share capital or reserves or retained profits or earnings. Okay, this could be the sources of finance in form of equity. So the company will also be obligated to pay equity holders for using their money. So the money that is paid to these equity holders is referred to as dividends. So the cost of obtaining equity is referred to as dividends, and the cost of obtaining debt is referred to as interest. And we have also learned that this interest is a cost, is charged against the profits of the company. But dividends is a form of distribution. After arriving at the net profit, then out of the net profit, the company can decide to pay the shareholders dividends at the end of the accounting period. So that is what we have learned today. We have also looked at the factors that determine the cost of finance, We also discussed the importance of cost of finance. How is the cost of finance important? Now with that, we come to the end of our first lesson. In our next lesson, we'll move ahead and look at other aspects which we mentioned when we are starting the lesson. Thank you for now. God bless you.